Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nick Shermans and Aaron Varghese work for Pure Portfolios. Any opinions expressed by Nick and Aaron or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everybody, and welcome back to another episode of Blind Spots. In our last episode, we talked all about how all advisors are different. There's a common misconception that all advisors are the same. So we discussed the different types of advisor services that they provide to help arm you with information when it comes to finding a new advisor. So piggybacking on that theme, as advisors, we talk to a lot of people, prospective clients, and over time, we have noticed different common trends and themes from prospective clients. Some good, some not so good. So today we are going to be diving into the weird stuff that people anchor to when they are in the pursuit of a new advisor and how these things can lead you to choose an advisor based on the wrong criteria.
Yeah, so the premise of this is we want to help people tighten up their process. You know, we can't tell you what type of advisor is best for you, but if you follow a sound process, you're probably going to have a decent outcome. So we're going to highlight some things that people anchor to that make zero sense, that often have the potential to lead you down a wrong path. And many people find out too late that, the advisor they chose probably wasn't the best fit. And one common theme too, and we didn't talk about this in the notes, but I was thinking about this. People tend to rush this choosing advisor path, right? They hastily hire someone and they spend less time hiring an advisor, which is a very important decision, than they would like planning a vacation. Mm-hmm. And I can't understate enough how important it is to take your time, to do your diligence, and to understand what you're getting into. So we're going to help you build that framework. It's pretty straightforward, but if you follow this, chances are you're going to find an advisor that fits.
Yeah, and these are kind of the what not to do items, and they're not inherently bad, but can lead you astray. So if any of these things resonate with you, or you have chosen an advisor based on one of these items, I would encourage you to go back and look at who you're working with and just ensure that they are the right fit for you.
So what's the first one, Aaron?
First one on the list is people tend to choose the first advisor that they talk to. And this is not good for a couple of reasons, but as we talked about in our last episode, there is a wide variety of advisors to choose from. It's 2022. There isn't just like one advisor down the road. So we encourage prospective clients to talk with at least 2 to 3 different advisors, find the best fit for you, ask all the questions, because you're going to get different answers from probably every person that you talk to.
Don't we have a blog post or a podcast about questions we would ask an advisor?
Mm-hmm. We have both. So we will link the podcast episode, which has questions in there of real questions to ask your advisor, and the blog post as well on helping you vet an advisor.
Well, I think the first filter should be the advisor should be a fiduciary. Like that's not some special thing. That should be table stakes. That should be the bare minimum. Mm-hmm. You want to work with someone who is a fiduciary. I've seen people look for an advisor, stumble upon a non-fiduciary advisor and hire them. Like if you're doing that in 2022, you are asking for trouble. So make sure your advisor has a legal obligation to put your interests first. Okay. And then the other thing is understand what you're paying in fees, understand their fee structure, understand how they're compensated. It's not always straightforward. Advisor fees can be confusing, but at the very least, before you proceed further in the conversation, have them itemize in writing how they're compensated, what their conflicts of interest are, and how they're paid. And if your advisor is not forthright with that information, run the other way. Our fees are on our website. It's no mystery. And if you want to test them, I mean, this might seem a little odd, but you can go to their ADV, which is a regulatory document. It's usually on the homepage, the bottom of the advisor's site. You can find this and see what their fees are. So this is a document they have to submit to the SEC, and just a check and balance if what your advisor is saying lines up with what you're actually paying if you were to work with that person.
Yeah, and there's nothing wrong with hiring the first advisor that you meet with, but it's a good idea to also talk with other advisors, because the first one you talk to may be the best fit, but if you're not comparing that against other advisors, you don't necessarily have a baseline.
Yeah, right. Yeah. So I talked about fees. Make sure you understand their investment process, how they would manage risk, right? This year's been a little uncomfortable. Like, you want to understand their framework for making portfolio changes, okay? Mm-hmm. Understand the services that you're signing up for, understand the credentials that your advisor has, how they approach taxes, and how they would communicate with you if you were to work with them. Like, these are all, again, table stakes, things you need to understand so you don't sign up and there's a surprise on the other end. Mm-hmm. One overarching theme, and I'll shut up. Get it in writing. Get everything your advisor says to you or your prospective advisor says to you in writing. There's a saying in our business, the biggest liar gets the business. These advisors can say anything that they want. You want to get it in writing so you can come back to it.
Yeah, I think advising is kind of an interesting industry where people are a little haphazard about who they work with. You wouldn't hire a real estate agent if you didn't know what services they were going to provide to you. I mean, it's like any other industry. You wouldn't hire that person if you didn't know exactly what you were going to get with what you've paid to them. So I think it's kind of fascinating how people just kind of throw caution to the wind and hire whoever.
Well, on that point, Aaron, there's a trove of information online. You can go to Google reviews, you can go to Yelp, you can look at your advisor's work history and see if they've had any marks against them, like if they've been a bad actor. Mm-hmm. So take your time with this decision. If other people haven't had a good experience, chances are you're probably not going to have a good experience. So again, look through Google reviews are a huge tool, and we've been very intentional about getting feedback from our clients. They've left us reviews. That's something that either we can use the feedback to change what we're doing or it validates what we're doing. So just make sure you're doing the research and take your time.
The next on the list is someone who chooses an advisor based on who their family members work with or who their friends work with. Why is that a problem?
Yeah, and that's not the worst sin, but it shouldn't be an auto hire based on like what advisor your parents work with or your cousin. Yeah, there's an element of trust, which is huge. Just because my mom or my uncle is working with someone doesn't mean it's the right fit for me, right? I have different needs, different goals, a different opportunity set of things that I'm looking at. We're talking 30 years difference. I mean, it might make sense, it might not make sense, but in general, a 70-year-old's needs are going to be different than a 40-year-old's.
Yeah, so just because your friend works with an advisor doesn't mean it's an automatic hire for you. And if your friend or family member is the advisor, doesn't mean that you should automatically hire them either.
Yeah, because I've seen people anchor to that. Oh, my friend works with them or my aunt works with them, and they'll share the advisor website. And you're assuming that the person working with that advisor is qualified to properly vet an advisor. Mm-hmm. And oftentimes I'll see egregious fees. They'll use mutual funds. They'll sell stuff. They'll not be a fiduciary. So don't assume that the person referring you is financially savvy and has properly vetted the advisor.
Yeah. Kind of piggybacking on that, overweighting time in the industry when hiring an advisor. So I want to be careful with how we word this because someone who has decades of experience could be a great fit. Someone who has 1 year of experience may be a great fit. So time in the industry, I don't think is necessarily a proxy for how your experience will be, but the sentiment that we want to convey is that this is an ever-changing industry and you have to stay up to date because it changes quickly. It changes year over year. And the person that you work with also needs to change with the times.
Yes. And the way I would put it is institutionalized. There's a point in your career when you've been doing the same thing over and over, year in and year out, and you develop a baseline that's anchored in a certain way of doing things. And I think look, the advisory business hasn't really changed much from, call it 1985 to the mid 90s, but post internet, it's completely changed everything.
Mm-hmm.
And I find that people that have been in the business for a long time, and of course there are exceptions, but they've developed a fixed mindset where they've anchored to this antiquated playbook of charging over 1% and using mutual funds and selling products and talking and thinking a certain way. So I would caution you, do not equate experience with a good outcome. Oftentimes, some of the worst setup advisory client relationships come from someone that is operating off a 1985 playbook. I don't know if that's a compliance nightmare, what I just said, but you want someone who's forward thinking, that's progressive, that's doing something different, that is transparent, that publishes their fees online, that doesn't use high cost funds, that doesn't sell stuff, that doesn't have conflicts of interest. So I'll just shut up.
I think the way to get this across appropriately is that within a fiduciary duty, you have to provide the investment options and services that are best available, best for your client now and in the future. If someone is operating today in the way that they operated in the 80s or 90s or even early 2000s, they by choice are not giving you what is best available because, like we stated, things have changed drastically in the last 20 years. And so if you are operating in a way that you were 20 years ago, you are just simply not fulfilling your fiduciary duty.
Well, and I think the way I play this forward, I'm 40, Aaron, you're 20 something. It's hard for me to believe that someone Aaron's age or someone my age is going to walk into a Class A office space, high rise, and go talk to a suit and tie salesperson broker, pay 1.5% for a portfolio of high cost mutual funds. Like that to me is a non-starter. No one our age is going to do that. So the other side of that is you have a huge faction of our business that manage trillions of assets that do that very thing, and they think it's going to last forever. So something has to give. Know that, in our opinion, that model, that way of thinking isn't the best approach in 2022.
Okay, well, quit harping on that. Next is all about designations and certifications.
So let's talk about Aaron's opinion of the two most accepted and prestigious marks for an advisor.
So the two with the highest regard is the CFA, Chartered Financial Analyst, or the CFP, Certified Financial Planner. Those are the two, like we just stated, that are kind of the best in the industry. There's a lot of people, and I like to call it alphabet soup, that just have a trove of designations after their name. And again, not inherently wrong or bad, but it doesn't, what's the word I'm looking for?
It doesn't necessarily equate to someone who has your best interest in mind. Like a lot of those are relevant, some are not relevant, but a lot of them are just for optics. And the two most respected, appreciated, intensive, and prestigious, I don't know if I already said that, are the CFP and CFA.
Just because you have a lot of letters after your name doesn't mean that you are the most knowledgeable or will provide the best service. It just simply means that you've passed a test.
Yes, and not all tests, not all criteria to get letters at the end of your name are created equally. Like speaking for myself, I've earned the right to use the CFA charter. Back in 2012, I sacrificed 4.5 years in my mid-20s studying for 6 to 8 months. That's a series of 3 exams. It took me almost 5 years. I failed the first go around, level 2. And I can tell you, there was a lot of sacrifice. There was a lot of self-study. There was a lot of times where I wanted to quit. But I know, like, I'm proud of that designation. I'm proud of the fact there's only, 180,000 CFAs on the planet. And I think it shows a commitment to discipline. It shows a commitment to a growth mindset. And again, I'm not here to tout the CFA, but if I'm a client, I want to understand why my advisor chose the various program that they did. And I like to hear about the journey. I like to hear about why they chose the CFP or the CFA or something else. I think it shows an ownership in your career and craft as opposed to someone without those marks.
I don't know about the other designations, but with the CFP and CFA, there's also an experience component that just because you pass the exam doesn't mean that you can necessarily use the designation. Like you said, you earned the right, so you met certain criteria in order to use it. And there is an experience component with the CFA.
I think it might be 3, and it might have changed, but like I have to sign a pledge every year. I have to commit to a code of ethics. I have to do right by people. Like I have to not only do right by clients, I have to champion the entire industry and promote doing right by people and moving it forward out of the dark ages, right? If you think about our industry, it's the most fined industry year in and year out. So the CFP, the CFA are trying to move it forward and get rid of a lot of these non-transparent, conflicted, misaligned incentive advisors.
Yeah. So to wrap that all up, it's just good to ask your advisor about what certifications, designations they do have, which ones they don't have. And like how you said, you ask about the journey of why they chose it, what's their background and explanation behind that, because there's a lot to choose from. So finding out why they chose one that they did is kind of says a lot. Okay, next thing that we have seen come up a couple of times from prospective clients in the last couple of years is
there's a website, I guess it's a program called the NAPFA, National Association of Professional Financial Advisors. Okay. And this program puts it out there that if you work with one of these advisors that are registered with the NAPFA, you somehow are held to a higher standard than someone who is not. But unpeeling the onion, advisors pay to be a NAPFA advisor, and I apologize, it's a ridiculous acronym. They pay to be a part of that program, and in return, that program funnels leads to those advisors. So they put it out there like they're held to a higher standard. It's really a marketing ploy for advisors to join and get clients. So again, this is a perfect example of, on the front door, it seems like this is a good program. When you unpeel the onion, it really is just a marketing platform to funnel clients to advisors. And again, I'm not saying this is bad or it's wrong. I'm just saying what it is.
Yeah. Essentially a list that you pay to be on. And we have found that when you type in financial advisor near me into Google, it is one of the top ranked links for people to click on. So just is what it is. Okay. Next one is kind of a fun one. This may be a touchy topic, but we have found that there are advisors that use a quote unquote in to make common ground. So this might be some kind of affiliation with a local group or club, maybe a religious affiliation, any kind of hobby that you make a connection with someone. Again, not inherently wrong to make a personal connection, but be careful with the topics that someone is touting in order to draw you in to their practice.
Yeah, and a common example, a common tool that has been used in the past to get prospective clients to bring their guard down has been, oh, my advisor's in my church. And again, I'm not saying don't do business with people in your church, but building trust in another avenue is great, but it doesn't mean that person is the best person to be your advisor. And if you've watched American Greed, you'll know it's not uncommon for bad actors to build trust in a different avenue or then to go ahead and do something that's not so good on the financial side. So just be mindful. Again, go back to this list. And if you do find someone that is in your golf club or book club or your church, make sure they go through this process and make sure they're the right fit for you based on what really matters when choosing an advisor, not on some common ground that is unrelated.
Yeah, I think the bottom line on this point is that you can find common ground on something unrelated to your financial matters, and that could be a good character fit. But at the end of the day, if they're not doing right by you in their day-to-day job, it's just not a good fit overall. Okay. The next one is one that we often hear of. If a prospective client did not choose to work with Pure Portfolios, that's fine. We often ask for feedback, what we could have done better.
And one answer that we commonly get is that they went with someone who was close in proximity physically to their home.
Yeah, and I guess this one depends on the personal circumstance. I mean, if I'm 90 and I like the face-to-face, and an advisor is okay but not perfect, that might be a sacrifice that I'm willing to make. One thing COVID did is it brought us closer together. Like, we have clients all across the country, and people are more conditioned, they're more comfortable working off a video or a Zoom call. But again, I realize that might not be optimal for most people. But I guess it just comes down to personal circumstance. If I'm anchoring to having a branch close to my home, but I'm being charged 2.5%, that's probably not a good decision. So I guess use your best judgment. If that's a factor, that's fine, but it shouldn't be the primary factor in why you choose an advisor because they're down the street from your home. As a matter of fact, one of the worst offenders prides himself on being the neighborhood advisor. And we take a lot of clients from this particular company. I'm not going to name them, but part of their selling point is just being in the communities and close to their client base.
So again, not inherently wrong, but not the reason to choose an advisor. Okay, getting close to the end here. The next one is misleading fees. And we talk about fees a lot, and of course the importance, but we find that there are a lot of advisors that are not forthright with the way that they charge fees. They're all in cost of investing. So Nick, give me your 30-second pitch.
Okay, so this, out of this entire list, this might be my most offensive item. I've been told 4 or 5 times in my career that my advisor does not charge me a fee. And just let's unpack that for a minute, okay? One, if someone says that to you, your advisor is not charging you a fee, don't walk, but run the other way. Okay, let's add this up. Most of the people, so 3 out of 4 people that have told me this, work with a advisor that works for a publicly traded company. Last time I checked, publicly traded companies have a legal obligation to maximize the bottom line. Okay, you're not special. They're not operating for free. No one works for free. They're getting their fee some way. It's just not transparent. So again, run the other way. Not being charged a fee doesn't exist. And there was some study, like I wrote a blog about this, but there was some study that 40% of clients that work with advisors think they're not paying a fee. I almost fell out of my chair. Like, that is the most egregious, delusional, naive assumption that I've ever heard. Your advisor is charging you a fee. They're just not being forthright about it.
Yeah. Or you haven't been educated on where to look or find out what that fee is. And that's also bad on your advisor too.
Okay, the last one, I know this is running a little long, but I used to watch American Greed show on CNBC. And without a doubt, I'd say 80 to 90% of the cases on there, and they're all sad, but they start with an unrealistic promise, a delusional return expectation, the promise of riches, like, oh, we're going to give you 30% a year in income. Like, rates have been low the last 10 years, so it's always about income. Like, oh, you get 10% income a month. It's like, okay, when the 10-year treasury's now it's at 3.5%. You know, it was at like 1.5%. That just doesn't make any sense. Like, that's not a realistic rate of return in a low rate environment. So use your common sense. Run it by someone that you trust. Don't fall for delusional expectations or promises. And again, get it in writing. That's an overarching theme. Get it all in writing.
Yeah, I think that your gut check is a good one to put in play here, that if something just sounds too good to be true, it normally is. So find those kind of little red flags. If something just doesn't feel right, it probably is not.
Yeah, and the last thing I'll say is, you might think, again, we're coming off as crazy or going off the rails. These are all things that we experience every single week through our content, our podcast, our video, our blog. We get people coming to us. Like, we have a lot of prospective clients that are talking to us, and these comments are all based on those conversations and feedback. So we're trying to help people make better decisions, just because there's a lot of misinformation out there. A lot of advisors will say whatever they can to get the business. We want people to have a framework for hiring an advisor, which could lead to a better outcome, or at least avoid a dumpster fire.
Yeah. So I hope that this list was helpful. If you have done or thought about any of these things, take another look at advisors that you are vetting to potentially hire, or the ones that you have hired, and Check the questions that you ask them against our podcast and blog that are linked below to see if the advisor that you are working with is the best fit. And if you have any other questions, reach out to us at insight@pureportfolios.com. We'll see you in the next one.